Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video trading alert that we have here and we do each and every single night on the membership side of our blog. So what we do is we go over all the opening and closing or adjusting trades. Now again, if you're watching this video on YouTube or somewhere else publicly online, you're actually getting this video about 7 to 10 days after it goes out to just our members. So the benefit obviously of membership, and you can sign up for a free trial at OptionAlpha.com, is that you get these alerts both real time and you get this video the same day that we make the trade. So you can go over all of the trades same day that we actually send out the alerts and go over the review of them, how we build the trades, how we close them out, etc. So today we actually didn't have any opening trades that went into the market, and we had 3 closing trades that we closed out at pretty nice profits. So I'm actually very happy about these trades, and really a great way to kick off May expiration after getting past April is with some really profitable trades. So the first one I want to go over is Facebook. So we actually have 2 positions in Facebook right now for May expiration. One is a just regular debit call spread that we had put on a while back. And then we went back in and sold some premium in Facebook with a vertical credit put spread. And so today we actually closed out that credit put spread with a really nice profit and bought back the 50-45 put spread for a 40-cent debit. Now you'll notice that there's still some time left in May, and we do have earnings coming up from Facebook. And since we already have a position in Facebook, there's no point in writing out earnings with kind of a double bullish position in Facebook, a short call or a short put credit spread and a long call debit spread. So we went ahead and closed this out. We made more than 50% of our max potential profit. We made $77 per vertical that we closed out. So it was a very nice trade, about $150 we made in profit, a very quick and easy trade. If we actually go to the chart of Facebook, you'll see that although the stock has not really dropped in implied volatility is still up in the 60th percentile, and that's mainly because we have earnings coming up on the horizon here. But we have seen a nice uptick in the stock since we sold that put spread, so that's obviously helped really decay the premium very quickly for our spread. The next trade that we got out of today is Cisco. So we had originally bought a debit call spread in Cisco, so anticipating that Cisco would rise and go higher. So we originally bought the 22-23 debit call spread, and we paid about 49 cents in debit, so about half the width of the strikes, which is what we usually continue to preach here. And today we closed that out at a 70-cent credit. Now this is one of those orders, if you've been watching and following these videos that I talk about where I have a lot of working orders and they just don't hit. This is one of those ones that actually has taken a couple days to actually fill. We've had this working order at 70 and it's kind of been bouncing around that $70 credit range, and then today it actually finally filled. So don't be afraid to actually place an order and let it work and have a GTC or good till canceled order working, and just wait for that price that you actually want to get out at. So for us in this trade, it was $70 that we wanted to get out on. We made $21 in profit per vertical that we got out of. So you notice that we have 5 verticals, so we made $21 times the 5 verticals that we got out of. So again, a very good trade for us. What originally was a 50-50 bet on Cisco going higher turned out to be a really profitable trade for us as Cisco moved higher with the general market and implied volatility continued to rise in the underlying security. This really made for a very good trade for us. This is actually one of the rare times that lately that we've actually traded long options, so been a net buyer of options and had implied volatility move up. So you'll notice that the stock, although the stock did move up, hasn't really moved up considerably since we bought the position and entered the position. What it really kind of helped us was this increase in implied volatility, which kind of added as an extra buffer in profit. So that was really good to see, and you'll notice that the reason is because we have an event coming up on the horizon here on our Thinkorswim platform, so that might have contributed to the rise in implied volatility. The next one I want to go over is our Iron Condor. So this is an Iron Condor that we had originally put on in IBM, and IBM has now gone through its cycle and earnings, and so the stock actually has continued to stay right within this range. We had originally put this on. Implied volatility was very rich and high for IBM, so we were able to place a very wide Iron Condor and still take in a nice profit. Now you notice we only did one of these and we took in a nice profit of $90, so it was actually a very easy trade, simple trade, low commissions, and we closed out of and bought back our 205, 210 call side and our 180, 175 put side for a 35-cent debit. So you'll notice that these are May expirations, so considering May is still fairly far out, there's no sense in waiting to make another $35 when we've already made $90 of potential profit. So we've made more than 75% of our max potential gain. Again, you don't want to just have this undue risk that's out there that could really sway this. So it's better just to take off the position and move on to another trade. So for IBM, let's take a look at the chart so you guys can see exactly where the security was trading. And you'll see even after earnings, the stock gapped lower but still stayed in our range. We were all the way down here at 180 on the put side, and on the call side we were up at 205, which is kind of even off the screen here and off the chart. So the stock actually gapped right in between, and we could potentially hold this thing for another 30 days or so, but you see it's just not worth the risk. If the stock continues to rally or falls after earnings, it's just really not worth the risk for another $35 in premium. The biggest thing though is that we had a huge drop in implied volatility for IBM, and this is naturally going to happen after earnings. So all these stocks that have earnings on the horizon, Twitter, Pandora, LinkedIn, Amazon, Cat, Netflix, Herbalife, Groupon, Facebook, etc., they're all going to have a volatility crush right after earnings. And this really helped with IBM having this iron condor and being non-directional in our trading, seeing a volatility crush, even though the stock gapped down about $10, which is still a considerable move. It still wasn't even phasing this security and our position, and left us with a nice little profit at the end of the day. So as always, hope you guys really enjoy these videos. Again, if you're watching this out there and you haven't signed up, go ahead and check out optionalpha.com. You get a free 7-day trial. We don't ask for a credit card. We don't ask for any of that stuff. We really want you to kick the tires, see if this is right for you, see if the type of education and training that we're doing really fits your style of trading and learning. So as always, if you guys have any questions at all, please add a comment below this video. I'll get back to all of those tonight or tomorrow before the open, and happy trading.